My name is Steve Vlasic, and I'm a partner at Richey May. We're a CPA firm that specializes in alternative investments. I just wanted to thank all of our clients and friends in the industry for joining us on this webinar, Common Challenges in Private Equity, Hedge Fund, and Venture Fund Valuations under GAAP. The reason why Richey May and Intrinsic Valuation decided to host this webinar is because when we talk with our clients, outside of raising capital, valuation is the next most common question we always hear. So we wanted to bring some value to the industry, hopefully make things a little easier for everyone. We will be offering CPE for the webinar. Please answer yes to the question on the screen if you'd like to receive CPE credit. In addition to that question, you will need to answer the poll questions that we'll be asking during the webinar and complete a quick questionnaire at the end of the webinar, and you will receive a certificate for 1 hour of CPE. Also, we will do our best to address any questions submitted during the webinar. If we don't answer your question during the webinar, you will receive a personal response in a separate email. I hope everyone finds this webinar beneficial, and now I'll hand this over to Josh Cashman, the Managing Partner at Intrinsic Valuation.
Hey, thanks very much, Steve. My name is Josh Cashman, and I'm here with my colleague Russ Williams from Intrinsic. Just a brief background, and thank you all so much for attending. I hope that we can add some value in our conversation around valuation issues. We're thrilled at the number of registrants to this webinar, which kind of confirms our belief that this is a hot topic in an area of interest, which is further underscored by the amount of work that we've done in this space recently related to the valuation of illiquid assets for hedge funds and private equity and venture capital funds. Brief background on Intrinsic. We're a valuation firm. We specialize exclusively in valuations of businesses, complex securities, financial instruments. We do valuations for financial reporting, for tax, for litigation support, and valuations of transactions. So that includes fairness opinions and solvency opinions. Russ, my colleague, who will be doing most of the speaking today, I'm gonna hold him back for a minute here while I do this introduction. But he's been really specialized and focused on valuations for financial reporting in the hedge fund, private equity, and venture capital space. And so he's got some real-world experience, and we'll touch on some of those experiences that he's had recently in this presentation. So going through our agenda, hopefully that's the next slide up. What we plan to go through, you'll see that's a short agenda, but don't let that fool you. It's going to be a very long presentation. In fact, we hope to get through this in 40 minutes. The introduction, who, what, and why. We'll go through that briefly. You know, who we're addressing here and how this applies to you. We'll talk a little bit about valuation best practices, and this will sort of include some conversation around compliance issues. And so compliance is sort of, I think, an overarching theme, and maybe why several of you have decided to dial in today, to get a sense for where valuation fits in and how you might comply with valuation practices. And then finally, we're going to go through an example valuation and address some of the common challenges that we face there. So in the sample valuation, I hope that we kind of are able to address what a valuation would look like and what are some of the valuation techniques that we would use commonly in valuing any asset, frankly. And there are 3 valuation approaches that will be focused on there. And so we'll go through that in greater detail in just a moment. So moving on to our introduction here, the who, I think most of you guys know who the who are and who our audience is. We hope for this presentation to address folks at hedge funds, private equity funds, venture capital funds, and then a lot of our work, and I think by extension, you will be talking about operating companies, the valuation of those operating companies. Those are really the assets, the illiquid assets that we're thinking about when it comes to valuation. There are several different types of illiquid assets that may come up and may kind of spark interest in valuation. And we can certainly address those on a one-off basis, but I think generally the same concepts apply to an operating business that would apply to, frankly, any asset that you might value. These 3 different valuation approaches, one the market approach, the income approach, and the cost approach. And we'll emphasize that and go through that in greater detail. And then limited partners are simply those who are invested in those funds. And so limited partners is relevant insofar as those are the folks that I think most recently have been demanding valuations or at least clamoring for greater transparency into the valuation of the underlying assets that are held within each fund. And so limited partners are certainly relevant, but we won't be addressing them per se. So those aren't bolded there. The what, which is our next slide here. You may have heard these terms of art, level 1 assets, level 2 assets, and level 3 assets. We'll be focused on level 3 assets today. And these are terms of art that first came along with the codification of fair value accounting when the Financial Accounting Standards Board came up with FAS 157, which was fair value accounting. And there were these definitions of level 1, level 2, and level 3 assets. Level 1 assets being those assets that I think we're all most familiar with in terms of marketable securities. When you think of a publicly traded stock, one that's traded on a sophisticated exchange, you'll see level 1 assets. It's fairly clear what the value of those securities are because they have a very efficient market. They're highly liquid. A lot of people are trading in them. And so there's not a whole lot of second guessing what the value of those securities might be. Level 2, we're getting into a grayer area. There's a little bit more they're a little bit more ambiguous, these assets. Their valuation isn't necessarily clear. We may have to lean on another market to establish the value of that particular asset, and that particular asset may not have the most liquid asset, the most liquid market. So that might be an over-the-counter security, or a security for which there is no real clear market, but for which no real clear published or public market, but for which we can find some proxy for a market. Level 3 assets are what we're going to be focusing on today, and those are assets for which there is really no observable inputs in terms of establishing value. Those are illiquid assets. There's no real market for these assets. However, these are the assets where, though there may be more risk involved in investing in them, there's certainly more return, and that's usually what we're seeing for private equity, venture capital, and hedge funds are these illiquid assets. And I think that's where you might ask a third-party valuation provider to come along and help provide or help create an artificial market, and create is the wrong word, but help interpret a market to come up with a value for those assets. And then finally, why. And as I go into the why, I'm going to kick this off to Russ, who has a little bit more experience in dealing with the why or answering this question. But just initially, I'll say that Richey May and Intrinsic, I think the number of registrants for this webinar is a fairly good signal for why people may have interest in the compliance issues related to valuation of illiquid assets. The fact is, at least as we understand it, I think I speak for Richey May and for Intrinsic when I say we're getting more and more interest, we're getting more and more calls from clients saying that they're under more pressure by the SEC or other regulatory bodies to come up with third-party or independent or objective views for the value of the illiquid assets they hold within their funds. So I think that there is more pressure out there. We feel like we're sort of, and I speak again for Richey May and for Intrinsic, insofar as we feel like we're kind of at the tip of the spear or a leading indicator for those inquiries that are coming up. And I don't think that the SEC has necessarily come so far as to formally regulate the valuation or independent valuation of these illiquid securities, but with each iteration they're getting closer to that. And so I'll let Russ talk a little bit more about that in terms of your experience. What have you seen for greater enforcement here, Russ?
Yeah, exactly. I think really since the financial crisis, we've seen a kind of a shift in how the SEC and limited partners view these, as Josh mentioned, these level 3 or illiquid investments. We've really seen a big initiative driven from the limited partner level, and increasing the accuracy of performance measurement, within their own investments. In addition to looking at accurate performance figures for asset allocation, and really we've seen a few cases in the financial crisis, and really the SEC's initiatives following the crisis, really with these 2012 2015 performance exams at the fund level that highlights the need and really some of the problems that arose in the financial crisis. So we're going to highlight a few of those today through examples that become public through those presence exams. And really, again, overarching theme here is that the valuation of level 3 assets is becoming more pertinent and more in the forefront in the compliance space.
And it's compliance driven, right?
Yeah.
Yeah.
So we're going to go on to our first poll question here. We're just going to give you guys a few minutes to answer this for CPE credit.
What is that poll question? I believe the quote.
So you should see this on your screen. What type of firm or company do you represent?
All right, we've got an active crowd out there. Thanks for voting on that. We'll get those CPE credits delivered to you promptly.
Oh, yeah. So we're going to dive here into really the heart of our presentation and cover some of the best practices from two levels. Travis from Richey May here is going to jump on the line and discuss some of the trends and themes he's seeing from a audit standpoint. Then we'll dive into a few of the areas we're seeing and we'll expand on those for the remainder of our presentation in more of the valuation space. So I'm going to kick it over to Travis here to talk about the best practices from an audit standpoint.
And Travis, would you do like a brief introduction and just tell us about who you are and what you do and stuff like that at Richey May?
So my name is Travis Thomas, and I'm a senior audit manager with Richey May. As Steve mentioned earlier, in our role as a public CPA firm, we provide audit and tax services to a wide range of private equity, venture capital, and hedge fund clients. And I'm just going to kind of give a brief kind of general overview of what we look for on the audit side when we're auditing these illiquid investments. We definitely see a trend towards a lot more of these investments in the funds we work with. So probably the first thing we kind of look at is fund management's evaluation policies and the applications of those policies. Our fund clients range on a spectrum from large and with a valuation committee of multiple people to a 1 to 2 person shop where all the management decisions are consolidated. Either way, we want to see that management has a formalized evaluation policy that they consistently apply to their underlying investments. Additionally, management should be performing an ongoing valuation process to monitor whether or not there are any changes in valuation based on the policies management has in place. Now, this is really important because funds are having ins and outs. We want to make sure that the valuation of the fund is correct and being consistently monitored. If funds aren't closed-end, we often recommend these investments be side-pocketed. Once we have a good understanding of management's valuation policies, we typically want to get a copy of the valuation policies from the fund. Sometimes some of our smaller shops don't have a formalized valuation policy. In that case, we'd like to see at least a write-up explaining how each investment is valued, the inputs and the thought that goes behind valuation of the investment. Once we have a good understanding of the valuation methodology being utilized, we'll want to request and examine the relevant support for the valuation. And this is really where the audit work comes into play. I know we're going to be talking about various valuation methodologies as we go through this. Oftentimes we see valuation methodologies that are transaction-based, so maybe something like recent financing rounds. So we may want to request copies of their financing rounds, make sure they're executed, make sure the prices agree. It could be a model-based valuation methodology, so they make cash flow analysis. In that case, we're probably going to request a little bit more information. We want to make sure we understand how the model is being built. We want to analyze the model, get an understanding of the inputs being used. For any inputs used in the model, we like to review the sources, try to get some third-party verification of the validity of the input. Some cases, this could mean reaching out to the underlying investment for their verification or reviewing third-party public data if that's part of the model. Fund management is relying on a third-party specialist valuation service. In addition to performing an analysis, the inputs they use will probably want to review specialist credentials and expertise in the arena. I think that's kind of a broad basis coverage of what we do on the audit side, what we're looking for. Obviously, each case is going to be different. We're looking at different stuff, but that kind of gives a general overview. If anybody has any questions, Richey May, I think Steve's info is at the end of the slides, and feel free to reach out to him.
You know, I would say, this is Josh Cashman speaking in Intrinsic, and as I said, we've had several opportunities to work with Richey May along with the joint clients that we've shared, and Richey May does have a nice formal structure in place, and this is a shameless plug here, but it does have a nice formal structure in place that makes the collaboration between us and them a lot easier, you know, from a valuation standpoint and getting through the audit process. And that's important, and I think that's a reasonable sort of transition into our next topic here.
And it is nice to have a third party like you guys to work for.
Right. We'll scratch each other's back. But
yeah, so someone we know we can rely on.
Right, but that collaboration I think is relevant insofar as there's calibration that takes place, and so we've talked about these two themes that we're talking about. Obviously, there's this overarching theme. I think the reason why several people called was to glean or get a sense for compliance issues that are coming up. But when it comes to really the substance of valuing a company or an asset, or you know, an illiquid asset specifically in this case, which may be an operating company, it's all about calibration, which includes collaboration with the audit group. And so that's something that we've had some success with, and I think here's a nice transition for Russ to talk more about the calibration that applies in the evaluation process.
Yeah, and that we've really structured this as kind of a free-flowing, you know, conversation. So Travis, feel free to jump in anytime. But this is really kind of drilling down. As I mentioned, we'll hit the macro theme of compliance and, you know, valuation policies and procedures from an audit standpoint. But now we're kind of diving one level deeper into the core themes that drive strong valuations in our eyes. And really, this first bullet point, if you can walk away from this presentation with one, you know, item to remember or keep in mind, is this concept of model calibration. So in Intrinsic's eyes, you know, model calibration can mean several things, but really one of the first areas is calibrating a model to pass valuations. So you'll see we're going to talk again about a few SEC cases here. And one of the big themes is that, you know, these companies might not have been calibrating their models from period to period. So having consistency and reliability and assumptions and output and a story behind those is paramount in consistent valuations. Of course, you know, considering kind of moving on calibration, the exit price, considering the most opportune market to sell an asset in, and a fair price that would be gained in that market. Is really the concept of exit price, and really it's calibrating externally to the market that the company operates in. And finally, you know, and this is a big one in my mind, and I kind of talk to my team a lot about this, you know, in Intrinsic, and it's calibrating not only the model, but your story behind that model, and the qualitative factors that are driving your assumptions, and how the outputs are flowing from period to period, and if all that makes sense from a story standpoint. Further, kind of a few other tools we use at a high level, or can be used, triangulation of valuation methodologies. We always approach evaluation from multiple fronts, and considering how, you know, valuation methodologies are coming in at different levels, and having a story behind that is critical for us in coming up with a reliable value. And finally, this is a trend that we've seen in private equity firms especially, but the ability for private equity firms to backtest retrospectively their valuations based on realized exits really helps build that story in keeping consistency with the fund's investment thesis and how they approach exits, and that's obviously ultimately hitting your exit market assumption. So really it comes full circle, and going back to the big picture here, we're going to be focusing on that calibration concept.
Russ, now you've gone through all of these points where valuation works right. Give us a sense for when valuation maybe doesn't work so right. What's some of the downside risks related to where valuation isn't strictly enforced or imposed?
Yep, exactly. So we're going to dive into a few cases came to light post-recession and the SEC's big initiative with presence exams. And the Yorkville case, I think, is the first one that we wanted to highlight. Essentially, Yorkville was a company just investing in primarily convertible securities and distressed public companies. It was a great strategy pre-recession, but as the recession hit, they switched to more of a buy and hold strategy, buying those notes and collecting interest on them, and not exercising conversion to common shares. And really, what the SEC, as it came in, in 2012 post-recession, what they saw them doing was carrying these notes at face value and kind of just ignoring the credit risk that was skyrocketing, especially in that tier of distressed public companies they were invested in. So that was a big area that the SEC focused on. And ultimately, they had overstated, in the SEC's eyes, allegedly, the asset values in their fund by $50 million, therefore, overcharging LPs those management fees in the recession. So that was the big, this is one of the highlights, really a potential downfall in valuation policy and potentially calibration and not considering credit risk in that model.
Mm-hmm. And this is an example of, where you've got that risk of there is a real conflict, a real potential conflict, and the real issue comes up where there's not necessarily intent here, not necessarily intent to defraud or to boost management fees, but there is no doubt that the error kind of falls in the general partner's favor, and so it implies that there could be some intent, no doubt. Because it inflates management fees. I'm sorry. Go ahead.
Yeah, it's really the fact of it. In this case, it was interesting because it was really more the status quo they defaulted to. That status quo was incorrect in SEC's eyes, and they're very aggressive about that.
Right. So it wasn't like an intentional action.
Yeah, exactly.
Per se. It was inaction, which resulted in this overstatement. Yeah.
So we just wanted to highlight a second case. This was GLG Partners. And this is more of a equity method investment. They had a 25% minority stake in an overseas mining company. The original investment happened really right before the recession hit in early 2008. That 25% stake was bought for $210 million, and ultimately, over the coming months, the fund doubled the valuation to $425 million. And really, their claim was that the production was going to quadruple, and that gold prices were going to skyrocket or be bullish over the coming years. However, as we all know, the recession hit. Coal prices took a turn for the worst, and emerging markets were in free fall. So we found, really put a blind eye to those factors, those really big factors for valuation, and continue to hold that investment at $425 million through the recession. In 2010, yes.
Just jumping on the other side, that's something we see a lot and sometimes have issues with is a lack of ongoing monitoring of investments where
investments may be held at cost or there may be a write-up and they just leave it. There's no change, even though there may be something in the market that says there should be a change in value.
Yep, exactly. It's always a tough decision when to pull off the cost basis.
Right. Exactly. And that's something that needs to be a continued monitoring monthly, quarterly, annually of the investments.
Exactly.
And we face similar circumstances again where you have savvy institutional investors who have bought a distressed asset. That asset may appear based on their intel worth much more than what they paid for it, and that's clearly the business they're in. But then the risk is marking it up and realizing that at some point you may have to mark it back down. So there may be some value in being conservative at the outset. Again, that question comes up often for us, is marking it up initially.
Yep, exactly.
Right. And even if you do leave it at cost, the ongoing monitoring aspect where you need to write it down. Don't just leave it at cost. Cost may not be a correct value.
Yeah, exactly. And so in this case, just to wrap up GLG, the fund had the SEC claimed overinflated fee revenue by $7.8 million, and they ended up paying that back to investors. So ultimately, that was a case of, again, just like we just wrapped up, a lack of model calibration, policy oversight. So we're going to move on now to poll question number 2, and we'll pause a few moments here to let you guys answer this question for the credit.
All right, everybody remains very active out there in answering questions. Thank you very much. We'll get those CPE credits delivered. Move on here. Go for it, Russ.
Yep, so now we're going to dive into the final part of our presentation, which is really diving into an example valuation and highlighting the 3 valuation approaches and the common themes and challenges we see in those approaches. So I put a lot of words up here on the screen, but big picture here, we're going to assume this hypothetical example that we have an investment fund that has a minority co-investment alongside a lead private equity firm. So that lead private equity firm is structured a holdco that both entities are invested into, and that holdco's job was to go out and acquire 100% of an operating company in the cloud storage and co-location space, so a very capital-intensive business model. This operating company has performed well in the historical period. It's doing $100 million in trailing revenue, strong revenue CAGRs over the period, and what we'll discuss, appears to be strong, strong EBITDA margins in the 14 to 18% range. And so, again, last hypothetical fact pattern here, we're going to be doing this valuation at mid-year 2016, so 6/30/2016 is the valuation date. So I just wanted to dive a little more into that, the capitalization table at the holdco, at the holding company. We've structured this hypothetical in a fairly typical private equity structure, where you have a preferred stock being the primary invested security, and that preferred stock in this case is $60 million of investment, and that investment accrues a PIK, an 8% PIK through time on an annual basis. So if the company is liquidated for less than that accrued paid-in-kind interest plus preferred investment, the common stock would get 0.
And just to be clear, Russ, we are doing this valuation for the co-investor here.
Yep, exactly. So you can see there we've highlighted that co-invest preferred and common units in red there. So
which is a hypothetical client or the subject entity.
Yep, that's the subject, exactly. So we're doing this valuation for the co-investor at 6/30/2016. And you can see here, really all the upside will be taken by the common stock, but the preferred stock will have a downside protection in the structure. So we just wanted to highlight and kind of frame the company's position for the audience, and we can hit the high level here. We won't dive into each detail, but ultimately you'll see the LTM period is highlighted in gray here, and revenue growth has been fairly strong over the trailing period. With as you can see, as we move down this chart, EBITDA margins being in the 14 to 18% range on the trailing basis, and you can see there's been some struggles from a free cash flow standpoint to generate positive free cash flow in a trailing period. This is, as I mentioned, a very CapEx-intensive business model that requires building out data centers and data servers. But going forward, kind of everything to the right of that gray box is management's projections and their budget for 2017. So you'll see revenue growth is going to anticipate to tail off relative to historical growth rates. However, from a margin standpoint, free cash flow margins are expected to improve and bump up to the mid 4 to 6 range there in the projected period. And we're just reflecting all this in the chart below as well.
Right. And though you may not actually create a chart like that for every project, Russ, that chart is basically what you're evaluating in terms of sort of substantiating those the forecast data with the historical data. In other words, saying that the forecast data looks reasonable based on what the company's actually done.
Yep, exactly. And it also comes down, we'll talk about this later, but driving this projection, as Travis had mentioned, from the underlying fundamental level and seeing if that projection is indeed calibrated to the company's historicals and if calibrated to itself in the sense that revenue projections do have appropriate costs and CapEx to support those. But we'll talk about that here in a moment.
Okay, and one other point though, Russ, just on that slide is that clearly, and I just want to say this in terms of where you're headed with this, but just to make a special note for the growth and margin that you're clearly emphasizing in this chart, and that's something that you would evaluate in any P&L, both historical and projected, is just to see sort of those two elements have a special importance, which you'll talk about in a second.
Yep, exactly.
Okay.
So as I mentioned, we want to dive into the three main valuation approaches, and we're going to start with one of the most critical, and as Travis had mentioned as well, one of the most reliable in the sense that there's less assumptions to rely on, and for this reason, the SEC does bias towards the market approach in many cases for those reasons of objectivity. So as you see in the top right box, we've highlighted we're going to cover the guideline public companies and guideline transactions under the market approach. And really the big picture here is you're looking at publicly traded companies and their implied enterprise values over the revenue or EBITDA or free cash flow of those companies to imply valuations to a subject company. I know you all are very familiar, likely most of the folks on the phone with this approach, so I don't need to dive too much into there, but transactions, it's the same idea. You're looking at the implied enterprise values and transactions relative to the revenue, EBITDA, free cash flow of those companies. So I think the first and maybe the most on the surface obvious point to hit is one of our key functions is comparing the data set as a whole to our subject company. Me and Josh will see a lot of valuations, call it a middle market company as well, where large public companies are being considered as valuation comps for that company, and I definitely take concern with that in the sense that large $1 billion+ public companies are going to trade at a lot higher premiums from a size premium standpoint, in addition to the amount of diversity that the public company gets. It's really just not comparable to most middle market companies. And also, I think two items to address, in addition to size, is profitability and growth prospects. So we've heard just a common kind of rule of thumb in the market in the last few years, and that's the 40% rule. So this rule says that to be a strong, really later stage SaaS company, a company has to get 40% EBITDA margins or EBIT margins plus growth. So those two must equal 40%. And of course, this is a rule of thumb, but I think it applies to the point that if you have a public company or a transaction that is kind of meeting the 40% rule in the SaaS space, and then you apply that same multiple to your subject company, that would be a problem in my mind. Any other thoughts there, Josh?
Well, I do think that going back to this theme of calibration, that the challenge here is so many early stage growth companies, particularly, they're successful by virtue of their uniqueness, or there's a market because they appear unique, and that then creates a challenge in terms of finding a comparable company. And so what this list does is it shows in no case are we necessarily confined to finding a business that has the same industry vertical or same industry description or profile as the subject company. We have to find alternatives to measure and to calibrate a market and to create this sort of artificial market that we wish to develop for the purpose of determining what a company like this would trade for.
Yep, exactly. Yep, it's more of the gray area that you're really relying on your calibration and storytelling to kind of imply that valuation. So that's kind of hitting the broad transaction or guideline public company set, but there can be inherent biases in that data, which we're kind of highlighting here on the right side. So starting with the public companies, would you have a public company that is thinly traded? A lot of times the enterprise value might not be valid when you're rolling that into a enterprise value to revenue multiple, for instance. A rule of thumb we use is that a public company must have 5 to 10% of its outstanding, or not outstanding, but fully its market capitalization turned within 6 months of the valuation date. So we see several of these cases come up where the valuation or the public company is too thinly traded to imply the valuation.
And that's an interesting point. That's a great point because, again, going back to this level 1, level 2, level 3 assets, just that emphasis that the SEC has for financial reporting on using a market-based approach to trying to find a market. I mean, traditionally, when you think of valuation, you're thinking of a discounted cash flow analysis. You're thinking about, evaluating the company's forecast information, which we will talk briefly about. But here it's like this emphasis on the market. And when you're looking at thinly traded like OTC stocks, that really don't have an active market, that remain fairly illiquid, where you'll see vast fluctuation in huge disparity from day to day in price. That price indication is not an adequate indication of what the market would bear for that stock, because it varies so radically from period to period. And I think that's a really interesting point, because at that point your initial reaction is to say, this is a publicly traded company, it's a level 1 asset, price times quantity equals quantity of shares outstanding equals the value of the company, the market capitalization. But in fact, you can argue against that and say, well, this is so thinly traded that the market is not an adequate indicator of value. We have to point to the company's fundamentals and maybe disregard the market approach or find some other market analysis, including, leaning on an income approach. I just think that's such an interesting point, that pulls away from the level 1 asset that you would originally assume, and it may actually be a level 3 asset.
Yep, exactly. And then 2 other points, more on the transactional space. Access to data is always a challenge, and many times private deals don't produce the multiples of those companies trade at. So we use platforms such as CapIQ and Bloomberg to pull data that's available, whether public or private. But it's just a general challenge that we face on a day-to-day basis. And of course, the age of transaction data. You look at obviously any transactions that happened in 2009 or 2010 are going to be tainted from the recession. In addition, we've seen a lot of change in the SaaS space over the last year, with a lot of multiples contracting, 40 to 50% over the trailing year, and the VC environment in Silicon Valley really changing over that last year. So you really have to question data points from pre-2014 or 2015 in that SaaS or enterprise software space. And so we just wanted to give you a quick example here to overwhelm you a little bit. Big picture here, we're looking at applying a transaction multiple to our subject company. And really, as we move from left to right in this chart, you can see we're comparing just the general operating statistics of these transactions, in addition to their implied revenue and EBITDA multiples in those transactions. So I think it's a great point of calibration and diving one level deeper into the story behind the data. As you can see here, the revenue multiples in this space averaged out there at the bottom below the second big red box at 5.26x on revenue, so 5.26 turns on revenue. So one might be tempted to say, well, that's a good average. We'll take that into our subject company. However, as you dig one level deeper, you look at these EBITDA margins that the transactions had traded at or had on a trailing basis. They're very strong. They're at 33% average, whereas our company on the trailing period only has an 18% EBITDA margin. So this really tells the story behind, is a 2.2 or 5.25x multiple on revenue a fair data point? I would argue definitely not. You can look at this chart down at the bottom to see a visual of the data, and you can see there's definitely a positive correlation between EBITDA margin down the x-axis and the revenue multiple of those companies on the y-axis. But we've charted the blue dots being the public or the transactions, and the red dot being our subject company. And you can see it falls based on that regression at the very bottom of the scale, really closer to a 2.5x multiple. So in this case, we selected a 2.2x multiple for our subject company, which might have been over double had you just taken an initial glance at the data.
Right, which again goes back to that analysis that you had done of the P&L, both historical and forecast information. We've got what appear to be fairly good EBITDA margins, and so focusing again on growth and EBITDA and margins, the growth aspect is clearly relevant in terms of finding the right comparables. But then in this case, the margin aspect, again, I would have thought that 18% is a healthy EBITDA margin, generally speaking, but it turns out that looking at this chart and the comparable transactions that we've found, that works out to be sort of a watermelon, and you wind up with a much lower multiple.
Yep. So we just want to cover, you can see in the top right box, we're covering really the third area of the market approach. This is really one of the most critical ones. It's recent transactions and the subject company's equity, whether it be a controlling transaction or a transaction in a security within the capitalization table. So this is a challenge me and Josh come across a lot when we value private equity-backed holdings, and then also venture capital companies, or backed companies. And really, when we see a transaction in equity, we dive right into the story. That's right where we go. We don't go to the numbers; we go to the story. That story can be really driven by what is the investor group. Maybe if it's a security transaction, so down in the cap table, what is the nature of that investor? Are they informed? Are they a willing buyer? Is it an arm's length transaction? Those are questions we'll ask right away and hear that story. A lot of times we'll see middle market companies having transactions in common stock with the CFO and the CEO as they're transitioning in or out of the business. And that's really, you have to really dig one level deeper to see if that's a relevant data point from a common stock or preferred stock transaction standpoint. And then there are big challenges that we face really on a day-to-day basis is implying, if you have a preferred stock investment, how does that translate to a common stock investment or investment value? So we'll cover some of that here at the end. But that's definitely a challenge we come across on a day-to-day basis.
And so much of it, as you said, is the story, Russ. I mean, there are so many other areas there are secondary markets for private companies to trade their securities, and some of them are formal secondary markets. And in other cases, you have executives seeking liquidity, one-off transactions. And so again, going back to your story, is that really a relevant data point? Was it arm's length? Is it significant enough for this to hold value? In most cases, I would say probably not. But looking at the market approach and looking at transactions in the business itself is like the best indicator of value at the end of the day, so long as those factors are met.
So as you can see here, just continuing on with our hypothetical example, we didn't apply the market approach for recent transactions because the last deal was in 2013 with our subject company. So moving on to the second broad methodology, being the income approach. This is, as Travis mentioned, a viable approach and one we see applied in many cases. I know a lot of people on the phone have experience with this methodology. But the big driver here, as we had mentioned earlier on, is calibrating your projections. You've got to show, support that for your revenue growth and how you're driving that revenue growth via, increased investment in operating expenses, overhead, employees, in addition to, in our case, showing the relevant CapEx to grow to those revenue levels that are projected. So I'm really driving the model, projection model from a bottom-up standpoint is how we look at calibrating those models. We can dive a little more into a visual here within the DCF approach, but ultimately the consideration of the exit value assumption in DCF is critical. In many cases, you'll see it be the largest assumption within the DCF. In addition to the development of the discount rate with market participant assumptions and viable compared to the projection set. And the last area we look at from painting with broad strokes is the consideration for any non-operating assets that could be added to enterprise value after arriving at the present value of a cash flow stream, in addition to any future NOL benefits or tax benefits that the company owns at the valuation date. So here's a quick, we're just giving here a quick overview of a DCF for our subject company. You can see here we're moving from free cash flow stream and considering an NOL benefit the company had from their continued losses, and then moving down to take the present value of those cash flows. As we move kind of through the second half of this chart, you see a big area of assumptions, really the exit value we're building around and calibrating assumptions within a kind of a variant on the Gordon growth model, the H model, to ultimately get to the present value of the terminal value. And these assumptions, as I mentioned, are really important to calibrate to the overall market and the company's performance moving into that terminal period. So you'll see here as we roll up, we're in the gray box, the selected present values. You have 108 million being the present value of the terminal value, and then the 23 million being the present value of the free cash flow stream, in the interim period from now until exit period. So you can see the impact from the terminal value is very large.
Russ, I would guess that most people on the line are familiar with the discounted cash flow analysis and have probably seen something like this. What would you say in looking at the slide as sort of the key takeaway that you'd like to emphasize here?
Yep. So 3 key takeaways, or you can walk away with, is calibrating projections, using market participant and relevant assumptions for the discount rate, and then calibrating the exit value. So those are the 3 takeaways there. And really, I think the fourth, from a calibration standpoint, to bring that buzzword back in, you can see here in the red box at the bottom, we're calibrating our assumptions as we take the present value of the entire enterprise, and compare that to LTM revenue and EBITDA metrics, and compare that to where public companies and transactions are trading. I think you'll notice here that based on the company's lower revenue and relatively lower EBITDA growth in the forecast periods versus history, you see that 1.3x revenue multiple being much lower than the multiple we selected in the market-based approach.
Okay. So in other words, just backing into a way of reaffirming whether or not kind of a sanity check for market multiples that we had come up with. And then now we've got the cost approach, and the cost approach is probably why we're on the phone, is to avoid it in large part, like what Travis was saying earlier.
Yep, exactly. And this approach is probably the less used of the, or it's definitely the less used of the 3 approaches. And it involves taking the liquidation value or fair value of the assets less the liabilities. So really in seeing what's left over in that equity pool for distribution today. And really the cost approach is less used because determining the enterprise value or total asset value, unless we have a bankruptcy today, is really going to come back to the income and market approaches. So it becomes kind of circular in that sense, unless we have a company in bankruptcy or looking to liquidate today.
And I would say, if we're looking at the title of this presentation, Common Challenges in Private Equity, Hedge Fund, and Venture Capital Valuation under GAAP, the cost approach is probably one of the most common challenges that we face, and I would guess that the folks at Richey May face in terms of the valuation of illiquid assets in these various contexts.
Yeah, I agree with that.
Okay. We've got another poll question. For anyone who's after CPE credit, our final poll question will be posted. A number of answers on the poll question. We'll let Russ wrap it up here with equity valuation conclusion and kind of what it means to look at the various methods and finally come up with a conclusion of value.
Yep. So here we're just rolling up all of our methodologies we used, and this really comes back to the fact of triangulating multiple approaches. You can see here in that gray box on the right, we're hitting, and this doesn't always happen, but we are hitting multiple ranges, or all the ranges that we have from a valuation approach standpoint. Ultimately, kind of going down to a final conclusion on enterprise value, we decided to weight the comparable transaction approach at 60%, given the strong nature of that the regression we ran in the prior page and the ability to tell that story, as we talked about. In addition, and really further, the relevance and less assumptions are driven through that market approach. And then we weighted our conclusions from the DCF at 40%, understanding there's a lot of assumptions that drove that model, but also knowing that it incorporates a lower growth rate and a lower free cash flow stream in the future. So from there, from that enterprise value that included enterprise value, we subtracted debt, added cash to get to our $124 million equity value.
And there again, at the bottom of the slide there, you've got your multiples that you're sort of using as a sanity check to make sure that the final conclusion is consistent with all of the implied multiples that you had arrived at via the other analyses.
Yep, it's all about triangulation and calibration.
Yep, all right, good. And then at some point, obviously, all of this value has to get distributed to the various parties in the cap table. How did that happen, Russ?
Yep. So ultimately, we look at multiple approaches, in allocating that total equity value to securities. So, and this is really one of the more challenging areas we come across, especially when you get into complex cap tables. Like this one, it's not just a simple matter of dividing up the common shares among that 124 million. We have a preferred stock that's growing PIK through time, and a long period or a long holding period anticipated. We're going to go through just a few basic approaches here to allocate that value. The first being the current value waterfall, and then more advanced option pricing model and Monte Carlo methodologies that we use very often to get down to that security value. And there's also a P1 approach that we use often as well. So this, I think folks in the private equity space will be very familiar with the current value waterfall. This would apply if I was valuing the interest at a date that was with a liquidation that was imminent or really near in the future. What this involves is taking that. Really, we're looking here first of all at the cap table summary at the top half of this page. Just recapping the capitalization structure. As you can see here, we have that $60 million preferred investment and the $14 million of PIK that is accrued at 6/30/2016. So moving down, we just have to distribute this $124 million through the cap structure. It's pretty simple math at this point. It'll flow first to the preferred investment. Of course, the common isn't getting any money until a preferred gets 100% payment. And second, we'll flow the $14 million through to the PIK. Now the preferred is all satisfied, and we have $49 million of distributions remaining to the common stock to divide up against the lead investor, co-investor, and management team. So that ultimately ends up in the two per unit conclusions you see in the gray box at $1,200 and $753. And we'll show you the roll up of that here at the end versus the second methodology. And this is essentially, again, as I mentioned, the current value waterfall is how the company will liquidate upon a sale. But ultimately, in this case, we don't have a sale at the door today. So the question is, how do you treat that accrued paid in kind interest that's kind of built through time? You can't waterfall it today. So again, I've treated, I made an assumption here about an exit event, which will happen in 3 years at 6/30/2019. You'll see in the top half of this page, really the only difference between our cap tables in the prior page is that the accrued PIK is taken through that liquidation date. So you'll see that on the far right column with a $28.8 million accrued PIK at 6/30/2019.
I'm sorry. I was just going to say, though, what's interesting about these two slides is that all other things remain equal. So the total equity value is the same, notwithstanding the fact that we're extending out the payment in kind period through 2019. So what that winds up doing is the company is in fact realizing more in the way of interest, but at the same time the call option related to the probability that common stock will ever participate is enhanced. So as that is enhanced as an offset, because the two values are mutually exclusive, that depresses the value, at least slightly, at least relatively speaking, depresses the value of the preferred interest, including the PIK, which sort of makes sense insofar as like the PIK is uncertain and the value isn't enhanced the longer it remains outstanding. Instead, there's some uncertainty around whether or not the payer can continue to pay it. So I think this is a beautiful analysis, Russ, that you put together here.
Yeah. Oh, thank you. It helps too. So,
right.
So ultimately, we approach that really with a simple call option, and the call option looks like the total equity value is really the total equity value we determined, that 124 million, as you'll see in that red box, and then there's a strike price based on the total investment and accrued PIK at that exit date. So we essentially look at that under a Black-Scholes equation and say, based on that strike price and that stock price, what is the value of the call? In this case, if you move to the right, we determine that the value of the call option that the common stock really exhibits is worth $50.7 million. So that gives you an idea of what the probability and the resulting payment is of the call option getting in the money. with, as Josh said, the residual rolling back into the preferred units. And this might seem like a foreign concept, but I think as Josh explained, you really see you have to think about the go-forward equity value of the company being a risky investment, and it can go up or down from there, and the common stock is really getting more value from upside participation than the preferred stock, because the preferred stock just has its pick and investment return. So,
and it's a similar concept to how you might value debt. I mean, with the same idea, this idea of a call option, the enhanced value of the call option might in fact depress the value of debt. And so the debt is not necessarily valued at cost, but instead fair valued using an approach like this for both the equity and the debt piece.
Yeah, it's like distress.
Right, exactly, distress scenarios. All right, good. I think we need to wrap it up here pretty soon.
So we're just rolling up our two approaches here. You'll see we're just comparing the current value waterfall in the first column, and the second column has the option value. So this shows you how that common stock actually did get more value in the scenario with the call option due to the future potential equity value of the company being on the upside, with the preferred stock coming in slightly lower.
So we have a question here about who has the call option and when. So if we go back to that prior slide, do you want to address that, Russ? Who has the call option and when? And again, this is a hypothetical call option used to value equity. So the common stockholders have the call option, this hypothetical call option, and the call option is based on this assumption that the preferred units are sort of the threshold strike price. The underlying value of the company is the company price, is the underlying price, and what we're trying to arrive at using a call option value is the value of equity, common stock. In other words, the participating feature that applies after preferred has been paid out, and preferred includes that interest, that paid in kind interest.
Yep, exactly.
So the option holder are the common stockholders, and then in this case we extended the period out to 2019 in this particular hypothetical. So as that period is extended, the call option value is enhanced, and in some ways you could say that the PIK interest payment is depressed insofar as we're offsetting the two. And you can say that there is some risk associated with repayment of the payment in kind. So there's a discount rate associated with the payment of that interest over the course of the next several years.
If there's no overt call option, it's a structure. It's a hypothetical structure that we created to account for that building PIK through time.
Right, and to account for the value of common stock.
Yeah, exactly.
And we have another question here. Can you talk about the different types of valuations and the different circumstances when you've seen they are required? For example, a valuation with an opinion versus without an opinion. There are several different valuations and just generally, the contexts in which we operate are tax valuations, and I usually think about it insofar as the masters that we serve. One may be the IRS, so those are tax valuations. There's several different kinds of tax valuations that may come up. Then there is financial reporting. So I kind of think of that ultimately as being the PCAOB or the SEC, in which case then that's valuation for financial reporting. They're the valuations that Russ has been talking about today primarily. Again, how do you report back to your investors in a consistent manner the value of illiquid assets or the value of assets generally? Then there's valuations in the context of litigation or conflict. And then finally there's valuations in the context of market transactions. That's where opinions normally come into play. And again, the question has this follow-on, when would you need an opinion versus a standard valuation? An opinion is actually something that's not as common. We're clearly opining on the value of the subject entity, but you kind of, the word opinion when it comes to valuation is a term of art. It applies in solvency opinions and fairness opinions, and you might need a solvency opinion where a company is taking on additional debt. The board is making a decision that would enhance, that would benefit, that would both benefit them, and a decision that they're making, and so there's this inherent conflict. And again, if they're making a mistake that they benefit from, there's intent implied there. So where that comes up, anytime the board may be subject to real liability or exposure, they usually ask for an opinion to show that they've done their due diligence. And I think it's a legal matter that goes back to the business judgment rule to show that they have done their diligence in asserting this decision, and they've gone through the kind of formal business judgment rule, which is going to third parties for due diligence, and that's usually when an opinion is required. And a fairness opinion is usually when somebody is in some way, a minority interest holder is in some way diluted, and it may be required, and it may be fair that they be diluted based on market circumstances. Their fairness opinion might be required. So thanks, Russ. I just wanted to get through that quickly. There were a couple other questions that we can speak to directly as well. And then Russ, if you want to just wrap up here about discounts and other considerations, did you already talk about that?
Yep. We're pretty much done here, but just other considerations after arriving at the concluded equity value, I would take the option value in this case because of that pick. But just because the company is not liquid for multiple years, it's going to trade down versus transactions seen in the public or M&A space. Of course, there's always issues we come across versus control and minority values on a per share basis. So there's some other considerations to keep in mind. And with that, I think if you want to close it down.
Well, thank you all so much for taking the time. We tried to get it within the time limits, and if any other questions come up, please don't hesitate. I think we have several here that we'll address more directly, both the folks at Richey May and for any of those to which an answer might be required from Intrinsic, we're happy to answer those as well. Any questions that come directly, we're happy to jump on as well. Thanks so much for taking the time for it.
And anyone that's waiting on CP, you should see a survey come through now. If you just complete that, you'll get the certificate shortly afterwards. Thank you.